Because the government has to continue to borrow $1 to $2 trillion every year just to cover its spending, it sucks that liquidity out of the markets. There's a crowding out effect. This means that the cash in the system, the liquidity, is slowly being drained, just like it was going into 2019. And so while the Federal Reserve decided to maintain the amount of money that they are letting bleed off of their balance sheet at $25 billion per month, in other words, they are continuing forward with quantitative tightening for now, at a certain point, they will have to stop quantitative tightening very soon. It'll probably happen this year, and even reverse course into quantitative easing. Otherwise, you end up with the exact same situation that you had in 2019 and before the financial crisis started, where the banks don't have cash. They don't have the liquidity, and the entire financial system is at risk of imploding overnight. This is a situation called fiscal dominance, in which everything the US government does drives everything else. Monetary policy serves the government, not the other way around. This means two things. Short term, we are very likely to see continued volatility in the stock market. I've been warning you guys about volatility in the stock market for a couple of months now, and if you look back on what the S&P 500 has done over the last couple of months, it has indeed been extremely volatile. I still think the overall trend will continue higher because ultimately what we are seeing is an inflationary deleveraging, which means the government borrows insane amounts of money. It can't come from the existing money supply. Therefore, it has to be printed into existence through things like the Federal Reserve holding the Fed funds rate super low, quantitative easing, banks lending money into existence, different deregulation on the banks to allow them to print money, more money, in order to loan it to the government. This would be a change in banking regulations that would allow banks to consider treasuries as reserves. But in any case, this is an inflationary deleveraging because the government borrows money into existence that wasn't there before and spends that, driving prices up, driving long-term rates up, even though they themselves are able to deleverage because they get lower interest rates or a lower cost of service on their debt by inflating it away.